Welcome to Ask the Compound. On today's show, we're answering questions on the pros and cons of owning a vacation home with some personal experience from yours truly. Someone wants to die with zero. They literally want to go into the grave with zero money left. They want to ask us how to do the die with zero retirement strategy, working with a CPA, and what it means to change your filing status on a tax return, retirement distribution strategies, and these are the hot questions for boomers right now. We're getting a ton of these coming in. Muni bond funds and how much diversification is enough within fixed income. Sounds kind of boring. I think we can put a spin on it. Remember, if you have a question for us, our email here is askthecompoundshow@gmail.com. Today's show is brought to you by Public. Listen, the Fed may start cutting rates soon, maybe in the next few months, but those higher yields will stay here right now in the short term, right? So squeeze all that money you can out of the government at public.com. You can earn 5.1% APY with a high yield savings account, plus no fees, no minimums. Plus, Public provides up to $5 million of FDIC insurance, 20 times the standard coverage. That's a pretty good deal.
Not bad.
Here's a little disclosure. This is a paid endorsement for Public Investing, 5.1% APY as of June 17th, 2024, and is subject to change. Full disclosures in the podcast description. Hit that link if you want to check out more.
Also, great user interface.
It is. It looks
I enjoy
good.
That. It's good.
I agree. All right, Duncan, a few weeks ago, we had a show where we talked about a question from someone who asked, is a small cap premium dead? I even wrote a piece about this on my blog with some follow-up information. Reader wanted to know, not calling anyone out by name, but Josh and Michael maybe have said it's dead. John showed the little thing here, is a small cap premium dead? And since then, John showed the chart. This is through yesterday. The small cap stocks are up 10% since we talked about this on the show. Now, I never said there was a small cap premium. I just said, listen, maybe there's a diversification premium. And I'm not saying that I'm the world's best market timer, but I'm not saying that. No, I mean, the whole reason I say diversification is a strategy that's both a risk management strategy and an aggressive strategy is you never know where the returns are going to come from in a short period of time like this. This doesn't mean anything going forward. I don't know what's going to happen from here, but this is the kind of thing where you never know when these things are going to turn.
So what are you picking this week?
Talk to me later. Hawaiian shirts?
Okay.
I'm very diversified there.
Okay, you are.
All right, let's get into a question.
Okay, up first today we have, as someone who spends too much time thinking about buying a lake house, I would love to hear your thoughts. The argument that you will feel tied down and obligated to go to the lake house at the expense of other travel worries me.
All right,
this is the first lake house question, I'm pretty sure.
Yeah, I got a handful of these because a few weeks ago on my blog, I wrote a post about how it was my all-time high in savings in 2021. And I said that was a mistake. I broke out to new highs. Part of it was pandemic related, but I also said, you know what, it's not. It doesn't make sense to just save all of your money. So I said I remedied that in recent years. And one of the things I mentioned was, well, we bought a boat and we have a lake house. And a bunch of people said, well, fill us in on your personal experience because I'm thinking about it. So we bought a place back in 2018 in a brand new development about an hour north of where I live, pretty close to Lake Michigan on a lake that sort of runs into Lake Michigan. Really nice place. It's funny because the development at the time in 2018, they couldn't give these places away because it was a brand new development, new lots, kind of a up-and-coming area, and I'll spare you all the details about what happened and how I ended up trading that first house for another one. You can check my blog out for that. I'll share some more details there. But I wanted to talk about some of the pros and cons of owning a lake house in a vacation home since we've done it for, 6 or 7 years now. So let's start with the downside. And this person mentions it. Obviously, 2 mortgages, right? 2 bills for insurance. It's more expensive, duh, Ben, but it's still worth mentioning. It's more expensive, obviously. 2 bigger down payments. This one got me a little bit higher property taxes. So it's not my primary residence. We don't live there for a certain amount of days a year. Bill Sweet would count those for me and say I have to be like over half of the year there to get homestead or whatever it's called. So we pay higher property taxes since it's a secondary home. I think we pay double the property taxes on our lake house that we do on our primary residence. So it's a lot more money for property taxes. They don't give you like a break there. The statistics I saw on usage. So this person said, I don't know if I'm going to use it enough to buy it. Does it make sense? So I saw that on average people spend something like 6 weeks a year at their vacation home. We're higher than that because our place is only an hour away from the home base, but some people might not use it enough to justify the cost. So you could look at the cost of a vacation home and say I'm spending X amount a year on property taxes and mortgage and insurance, and then say how many weeks of Airbnbs and VRBOs would that get me? So I think that's a good comparison for people. I love going to the lake on weekends where we have a home base and we have all our stuff there. all this stuff for the kids, but some people might prefer more variety. So that is something to consider. There is obviously concentration risk. So owning multiple homes gives you way more concentration in the housing market. We have a big chunk of our net worth invested in the Michigan real estate market. If we have a tsunami come from Lake Michigan, which would be my son George's like ultimate dream. Like if there was a one way to go, he would probably pick tsunami. That's his favorite natural disaster is a tsunami. If something happens like Michigan, we're very concentrated in the Michigan real estate market. So I'm okay with this risk, but it's a risk nonetheless. If you just have more money tied up in real estate, it's a illiquid asset, obviously. All right, now for the benefits. For me, it feels like a vacation every time we go to this other house, right? They say psychologically the biggest boost you get from a vacation most times is the anticipation. Well, I get that feeling on a weekly basis because we go up there every weekend in the summer. And so I still get excited every time we go. So that part of it is a big psychological boost. It just feels like you're in a different place.
What's
like
the sweet spot of distance? How far away is this from you?
So ours is an hour. We have friends who have a place that's 3 hours north. That's a little, you have to probably stay for a little longer. For us, being an hour away and it's a quick, not a lot of traffic,
that's not bad.
That helps a lot. So I think if you're further away, and some people obviously buy vacation homes in different states, then you're talking about flying. And so I think the distance is a big part of it. For us, that's honestly one of the biggest selling points is that we don't have to drive that far away. Because every once in a while you have to go up there for, this is another con, I guess, is if you have deliveries, right? You're moving furniture there, or you're getting a TV delivered, or you need service people out of the house to do something. Going back and forth can be a real pain if you have to do stuff there. So that part of it can be a problem. I think one of the biggest positive externalities for us is that it's just more time spent outside. So we use it mostly in the summer because Michigan has 3 or 4 months of good weather a year. So we make sure we use it around the water. And our kids are outside all the time, swimming, fishing, boating, going for more walks, playing on the beach, going for bike rides, all this stuff. Check out that bass my son caught a couple weeks ago. Pretty sweet, huh?
Now, is this before or after your wife's phone went into the water?
This was around the same day, I think. So
Okay.
RIP to our iPhone. And I just think being outside and being by the water is kind of my happy place. So it does put me in a better mood. And I love the fact that just my wife and I and the kids, we're not on screens all the time. We're not watching TV. We're not on our iPads or iPhones. We're not on social media. It just is an excuse to be, it forces you to be outside more. So
do you even have a TV there? Or do you have a cabin style?
Oh, come on. No, we definitely have a TV there, and internet. And
well, you just said you don't really.
Yeah. And so that's part of it, though, for me, is like it's kind of like a remote semi-retirement in my midlife, right? Because our job affords us the ability to work from anywhere, pretty much, right? We've even done these shows from different places. So we often extend our weekends in the summer to Friday to Monday. Or over the 4th, we stayed for probably 10 days up there. And I can bring my computer, and I have a whole setup there. I have a whole setup for podcasting up there, too, where we can work from there. So the ability to combine that work, then also just walk right out to the outside and go on the water or go on the boat. That's one of my favorite parts of having another place is just you have this place to call your own. I think some people look at it as a rental as well. You could rent it out. Our association doesn't allow Airbnbs, but I think that's something a lot of people look at is as a way to cover a lot of those higher costs is you just rent it out, and a lot of people run them out.
Do you have an HOA fee?
We do.
Okay.
Yes. So the upkeep part is probably another con that I should have mentioned. If you have a place that's further away, the upkeep is a lot harder if you're not there all the time. We have an HOA, and they take care of lawn care and snow removal, and that's another cost for us. But that can be tough for people if they don't have that, where they have to take care of that stuff themselves or pay someone else to do it, from the property manager or whatever. So yeah, I think the Airbnb thing is something a lot of people think of. Well, I'll do that, and then but the problem with that is you end up potentially having to rent it out during the prime times you want to be there. So that's kind of a trade-off. Someone also told me one time, like, if you buy a place on the water, it will never go down in value. That's obviously an exaggeration, but it's got to be true, like, I don't know, 90% of the time. So I think from an investment standpoint, it's a good hedge, I think, in that respect. As long as, again, Lake Michigan doesn't engulf us. But I think that for me, the number one selling point is just the memories we created there. So the timing for us was perfect. The interest rates were still low. Housing prices were still low. So it was easily like the luckiest financial decision we've ever made. But even if we lost money on the property over time, I think the investment has been worth it just from all the memories we've created. It just provides an excuse to spend more time with friends and family. We've had tons of friends come visit us there that we probably wouldn't have seen otherwise. I guess I should have preface this with, this is my, not to brag here, even having one, I feel, very lucky and privileged to have this kind of place. And I do worry a little bit that my kids are being spoiled, but I think that's totally outweighed by the quality time and the memories we've created there. So I am all for it with those caveats in there depending on situation.
I have one more question. Is there anything that Lake House Ben does that you don't do in your normal life?
I do a little stand-up paddleboarding there. I think I've talked about before. Kayaking. I'm more of an outdoorsman. Like, I was never a fisherman growing up. My son and daughters love to go fishing, and I had to learn how to fish. I'm not an outdoors person, so I had to buy all the stuff, and I have no idea what I'm doing there. Trying to tie a knot, and sometimes the knot will break, and I worry that it's because I didn't tie it well enough. And I'm like, geez, kids, be careful, and I try to blame it on them. So I'm definitely more outdoorsy up there. That's for sure.
Another one that can be fun is magnet fishing. I don't know if you've watched those videos, but people pull all kinds of cool stuff out of bodies of water with these big magnets. It's pretty fun.
That makes sense. I don't know if the iPhone would come up from that, but
yeah, maybe.
Yeah. So anyway, I'm pro if you can obviously swing it, and I know a lot of people can't, but just having that extra feeling of vacation. And one of the reasons we got it in the first place is because we had our twins, and we quickly realized we are not going to be able to travel for a long time because car seats and pack and plays and all the crap that you have to bring with you when you have kids, that was impossible. We had twins and a 3-year-old. We knew travel for us was out the window. We weren't going to be able to fly anywhere. Driving was a pain because you have to bring so much stuff with you. So having a home base for us, that's one of the reasons we did it in the first place.
All right. Well, it sounds like you made a good choice.
Yes. Plus, all my Hawaiian shirts I get to wear there, it fits with the theme.
No one's going to judge you. You're at the lake. It's
All right.
Lake Ben.
Next question.
Okay, up next we have, this is a two-parter. It's a long one, but a good one. My wife and I are in our mid-50s and served 22 and 27 years in the Army, respectively. Shout out to Bill the Taxman. I started as a tanker at Fort Hood, Texas, and then branch transferred to EOD as a young CPT. I'm going to have Bill explain some of this to us when he comes on. I've been semi-retired now for almost 6 years, working part-time as a grant writer for a nonprofit, the U.S. Bomb Technicians Association, and my wife is fully retired. Between our pensions, she retired as an LTC and me as a COL, and VA disability payments, we bring in over $220,000 a year after taxes, and our medical is fully covered by the VA, not to brag. We also receive about $30,000 a year in dividends from an unqualified stock portfolio that I inherited from my parents and have left largely untouched. We have about $3 million in another brokerage account, the Thrift Savings Plan, I know that one, and both qualified and non-qualified mutual fund accounts. Our house in Texas on 30 acres is paid off, and we don't pay property taxes because of my VA disability rating and the generosity of the state of Texas. Last bit of info is that our 21-year-old daughter is a soon-to-be senior at Texas A&M, and our 19-year-old son is living with us but working full-time. Our GI bills and their 529s cover all the educational costs. Given that our 4 adjusted for inflation pensions are more than cover our living expenses, if we start drawing down our accounts in January 2025, what distribution rate should we use to end up with $0 when my wife turns 90 in January of 2056? More importantly, how do I convert all of those mutual funds and stocks into a monthly cash payment? Our intent is to leave the house and our insurance proceeds, about $1 million, to our kids.
Holy smokes.
I'm out of breath.
These people, that was good, Duncan. Let's bring in Bill here. Jerry, it sounds like Jerry and his wife have things really figured out.
Hey, Bill.
Sounds like Jerry won the game.
Holy cow.
think
Wait,
so.
explain this to me, Bill, how you
Yeah.
cannot pay property taxes from the VA. How does that work?
Property taxes from the VA. I don't know about that, Ben. It's probably a veterans-based property tax reduction program, which we have here in the great state of New York, too, which I enjoy. Thank you.
So they served our country. Thank you for the service for both of them.
Yeah, wow.
And they're obviously taking advantage. Their medical is covered.
Yep.
They get these adjusted for inflation pensions.
Mm-hmm.
They're in a very good financial position, and they say, listen, we already know what our kids are going to get. We want to die with zero. So it's kind of like a two-part question.
Yeah.
I view this a little bit as Brewster's Millions. Remember that one? Richard Pryor, John Candy?
No.
I've
Never
never
saw that
seen
one?
this. I've never seen this.
John
Okay.
Candy. Wow.
This is people should need to watch this movie. So it was an inheritance thing, and they gave Richard Pryor $30 million. And he had 30 days to spend it. Now, this is back in the 80s, so I don't know what that would be adjusted for inflation. And the only rule is he couldn't really tell people he couldn't give it away. He had to spend it. And John Candy tried to help him spend the money. Very
wow.
good slapstick. 80s one.
Yeah, that's how much a house costs today here in New York. $30 million.
So they're trying to figure out how do you first of all spend the money from their qualified and non-qualified accounts. The distribution thing is a question again that we've been getting a lot lately, but they want to go big and they want to zero it out towards the end. I feel like you can't really use any of the spending baseline stuff here. I think you kind of go big early on, right?
Sure. Yeah, that's one way to do it. And I love the premise, Jerry. Jerry, EOD, that's explosive ordnance disposal. So if you've ever seen the film The Heat Locker from about 10 years ago, those are those guys. And,
Hurt Locker.
Yeah, certainly Jerry earned my respect. Also a fellow tanker. You guys can't see it on camera, but I actually have a dummy M830 round here, 3D printed here in the house that no one ever asked me about. I have something.
I
really
have asked
cool.
you about it.
That's true. That's true. Yeah. Duncan has. However, this is a math question to me, Ben. There's nuance, and we cannot answer a complex financial planning question for Jerry here. But Jerry's won the game, and the answer is $172,000. Right? That's the answer. If you have a $3 million balance, you're age 55 today, and 2060, if you spend $172K a year at a 5% rate of return, you're going to end up with basically zero. And Ben, I love the idea. I love how you started this with you're doing something awesome for your kids. You're spending time with them. Jerry's like, F these guys. I gave them an education. I got them to college, and they're going to have to do it themselves.
If he wants to do his Brewster's Millions and give it away, listen, spend some money on your kids, take them on vacations.
Exactly.
Chris
buy
Hayes
a lake
in
house
the chat,
if you want.
Yeah, Chris Hayes in the chat says they should buy a lake house.
Yeah, maybe. Give away to charity when things are going well. And to your point, Bill, if you talk about the return and what you get, and I don't know what their portfolios are in, something they've done pretty well if they got $3 million, but when things are going really well, ramp it up a little bit if you want.
I think so too. And you and Ben, you and I are at a point in our lives. We have young kids. We're involved with family. We love it. I would just love it if somebody were to sweep in and say, "Hey, let me take you on a vacation, right? Let me go do this. Let me take your kid. I'm flying to Paris next week. Do you want me to take your son? Absolutely. Get him out of the house. I'll talk to him when he gets back." Yeah. So I would really enjoy that. And Jerry, it sounds like again, you won the game. And so I love this concept. Ben, I don't understand why people have this desire to pass on money after they die. I do not get it. I get the point of helping people. You want to take care of your family. But a lot of studies show that money doesn't last beyond 2 generations. It's gone, right? And furthermore, the incentive you set up isn't great. You want people to kind of earn their own money. It's like earning a black belt, Ben, which I know you have. And if you don't earn that yourself, you don't know how to use it. You can run around chopping people up. There are Marvel movies about this.
And the whole spending of the money, I don't know. I think converting those how do I convert these investments into cash flows? I think you thoughtfully rebalance and you think about the tax ramifications, but they're in such a good place. I don't think it's really going to matter that much.
Yeah, totally agree. Texas, no income tax state, so you're winning there. The disability payment, not taxable to the federal government. I would just sit down with a qualified tax planner, Jerry, and game this out. And ultimately, how can you enjoy the benefit? I would not think, Ben, about converting the balance to cash. I would think, how do you convert that to memories, right, for you and your family for the rest of your life? Just like Ben Carlson
nailed
up there in Michigan. Boom.
Yes. And I want to say, there was a lot of people who tried to talk me out of the lake house at the time. Friends, family members, unnamed advisors at Riddles Wealth Management.
I just wanted to make sure you were sure. That was the big thing.
Bill was playing devil's advocate.
And based on that photo of your kids, I think, again, Ben Carlson has won the game.
All right, let's do another one. Bill Sweet in the
fun
title.
fact, you mentioned black belt. I was a red senior in Taekwondo. Little known fact. Yeah.
That's great. Taekwondo. Good
Did
stuff.
they wear the hat
Sam
in
Sweet.
Taekwondo, Duncan?
No, there's no hat.
It's just belts. Yeah.
Okay, question 3. Something Bill Sweet said on a recent show got me worrying. I think I'm getting out over my skis managing my own money. Here's my concern. In June 2022, I got married. In February 2023, my accountant filed my 2022 taxes with me listed as single because we didn't communicate well enough. Around this time, I made my annual $6,500 contribution to my Roth IRA. As Bill Sweet may know, the only way someone is allowed to contribute to a Roth IRA when they are married filing separate is if they have a super low annual income, which I don't. Even though I filed as single, I thought I broke the rule. So I then asked my brokerage to recharacterize my $6,500 Roth contribution to a traditional IRA contribution so that I wasn't breaking any rules. This was a headache in and of itself. This reminds me of the snip, snap thing.
I thought
from
exactly
The
of
Office.
that. This is Michael Scott.
Yeah. I then told my accountant what I did, and he said he could actually help us both refile with the correct status of married filing jointly, which we did. Then, because I wanted to get all the benefits of my Roth IRA, I recharacterized the money I had recently recharacterized back to Roth from traditional. Did I trigger a huge taxable event for myself in my Roth IRA? How does the IRS even track this stuff? Does RWM do individual tax returns? I wrote this up and gave it to my accountant in 2024, but I just don't have that much trust in this being done correctly.
What a mess. Bill can attest to this. We do individual tax returns now for our clients.
We do.
Bill and the other Bill have set that up nicely. Is there even a reason when you're married to ever file separately? Like, what's the reason there? Does it ever make sense to not file jointly?
The most common reason, Ben, would be multi-state. That's the most common
Okay.
reason. If you have one spouse who, let's say, is in Texas with our guy Jerry, and if another spouse in New York or California, one of these high-tax communist states, you might think about filing separately. Another example would be two high-income earners without kids is another very common place, because there is actually a marriage penalty of a certain range in the tax code.
So this whole characterization, recharacterization, back and forth, he went back and forth on his Roth like 10 times. Did he trigger some tax or penalties on himself?
The answer is I don't know, Kevin. It sounds like a big deal. I want to give Kevin some credit, though. I want to come out and say thank you, Kevin, because you did, Kevin, your patriotic duty. You realized there was a problem with your tax return. You realized that it needed to get fixed. You over-contributed to a Roth IRA instead of just like looking the other way, right? Instead of speeding on the highway, Kevin said, no, sir. I'm going to fix this with the folks at the United States Treasury, and I'm going to get this filed. So, Kevin, I give you and your CPA
Yeah, most people would probably just sort of let it go, right?
Yeah, I mean, yes, because that gets me to the second half of my rant here. How does the IRS track this stuff? Turns out there's not a national marriage registry, right? One of the reasons, gentlemen, I'm going to go on an aside here, point of privilege. One of the reasons I don't believe in any government conspiracy theories, if you, like me and Jerry, you've ever worked for the federal government, you realize nobody can keep a secret and nobody coordinates. Like there's no, like anybody, if there were three people that knew something went wrong, somebody shot JFK, Trump's assassin, whatever it was, that would be out in front page. It would be all over twitter.com or whatever they're calling it, y.com. That would be all over the place right now. So therefore, yeah, there's no national marriage registry. In fact, the IRS, Ben, relies on the good faith of taxpayers to do the right thing, report their earnings, and I give Kevin credit for doing so.
Yes.
So bigger picture, did Kevin trigger a taxable event? I mean, I don't think so. If he went from Roth and recharacterized traditional, A, that's the right thing to do. But then B, the Roth contribution itself there's no tax benefit, right? It's all in the future. So if effectively you moved money from a Roth IRA, you decreased your future tax-free income, which is the right thing to do, because again, you weren't eligible to make that contribution in the first place. But the most important thing I want to leave Kevin with is make sure when you sit down your 2023 tax return and 2024 as well, make sure that Form 8606 is tracked with your Form 1040. What is that, Ben? I'm sure that you're asking.
I don't know. If this happened to me, I would just wash my hands up and let you take care of it. Bill,
write
write a
down-
letter to the IRS for me.
Kevin, I need you to tattoo 8606 right here. I have the Roth IRA tattoo, and that's to make sure that your IRA basis is tracked every year. It's a very common thing that gets missed when you move from one CPA to another. 8606, you will get your traditional IRA contribution back tax-free, but on the distribution phase pro rata once you start taking distributions.
Okay.
Got it?
Complicated, but
There's a lot going on with Kevin. But again, Kevin did his job. God bless you.
Yeah. And
All right.
yeah, kudos being on top of things.
Yep.
let's do another one.
Okay, up next, we've got boomer questions here. I'm a 69-year-old university professor in a non-income tax state. I enjoy my job but plan to retire in a year. I've been contributing to my 403B for 33 years, and my total assets are $6 million. Not to brag.
Ooh, nicely done.
Yeah, well done. The allocation is 65-35, and the location is 70% 403B, 15% Roth IRA, and 15% brokerage. The brokerage account is divided into two master limited partnerships, and then they give the tickers, EPD and MPLX, that each yield about 7% in tax-deferred distributions, with a 35% stop-loss exit. What are your thoughts about using MLPs in a brokerage account to generate tax-deferred income during retirement? I'm attracted to the Guyton, sorry if I'm saying this wrong, but Guyton-Klinger guardrail process for retirement distributions. Although it's complicated, I've found a free Google Sheets application that simplifies the implementation. What are your thoughts about using GK versus the classic 4% rule for retirement distributions? Thanks in advance. I'm a DIY investor and greatly enjoy all of the compound.
Okay,
I'd never heard of this.
Ken here has done his homework. This is going deep into the like dark web of personal finance. Because like we talked about the 4% rule last year, the Guyton Klinger, it's essentially like, well, we'll get into this in a minute. Let's do the MLP start first.
Sure.
So Bill, MLPs, very volatile, but high income, right? I think that his things have a yield of 7 to 8%. What are the tax implications of MLPs? Because not a lot of people invest in these.
Yeah, so MLP, Ben, is not like a specific type of investment. It's not a specific type of strategy. It's a type of like tax organization. But the number one thing I think you need to look out for with master limited partnerships is unincorporated business income. That is a big one. And if you trigger unincorporated business income, which is basically non-passive income, which certain MLPs can participate in, if that hits your IRA, meaning like active income stuff like business sale, but it's non-passive. So dividends does not trigger UBTI. Real estate rental income does not trigger UBTI. It'd have to be something different. And some MLPs have this. And Ben, we've experienced this with our clients.
Do you get a K1 for this?
Yes, you get a K1.
That's what I was wondering too.
To your IRA. And then if you trigger UBTI, you then have to pay the tax at trust rates. The IRA has to as a trustee. So it's a giant pain, right? So that's the thing to look out for. I don't know. I'm not going to comment on these specific REITs or any specific investment. If they're real estate rental property, it's probably fine. My opinion, generally too cute by half, right? Risk cannot be destroyed. It can just be transformed. Anything that's talking about distribution rates, I usually run. But the big tax thing to look out for, you don't want to trigger UBTI.
My biggest worry about these using MLPs in retirement is if you're just using it for the income, that's fine. But these things are so volatile. And he has a stop loss, he said, at 30, 35%. But the MLP index was down like close to 80% following the 2008 crisis. So these things can get smoked. Yeah, that would be my biggest worry is the volatility.
And a 7% distribution rate, that sounds great. But like is our cash flow supporting that? Probably, right, in this market. But secondly, if I can get 5%, if I can get 5.5% from a bond, I don't understand what the extra yield is for.
Yeah, that spread there is not worth it.
That would be my argument, right? So again, investment specific, do your own homework. But I think in general, I don't like to play games with this stuff. But flip side, $6 million balance. Okay, maybe we can take on some risk.
Maybe a portion of it. A lot of people in the chat are saying K1s are a huge pain in the neck.
Oh my gosh!
I think you would agree with that.
Totally. I found out the hard way. My first year, I downloaded Robinhood, and I was like, "What's this Alliance Bernstein paying 8%? Yield?" And I bought it, and then I got a K1 in the mail.
Can't miss. All right, Guyton Klinger model created by a CFP named Jonathan Guyton and this computer scientist named I think William Klinger. It was basically a response to the 4% rule. It came out in the early 2000s in one of the financial planning magazines or retirement research things.
Yeah.
Basically, when markets are, it was a way to take the 4% rule, but also give you a higher starting point for distribution yields. And I think it's basically there's a lot of nitty gritty to get into if you're really interested. But it's basically when markets are trending higher, your distribution yield goes up. When markets are trending lower, your distribution yield goes down. So it gives you the potential to spend more money. I think you start with a higher starting distribution. Right. The problem is your cash flows are very volatile, and it doesn't stay on like a trend. Like if you compared it to a trend of the 4% rule, I think in the 2008 crisis, your spending would have been down like a third towards the trend. So that's the problem is it's more volatile. I mean, I don't necessarily have a problem with any of these distribution strategies, but I think you just have to use them as a baseline and adjust them to your circumstances and your spending habits and then the stuff that goes on in your life and the market returns that you get going forward. I don't think there's not one or the other that I say you have to use this one or not this one. Just you have to be a little more flexible than these models assume.
Right. Yeah, and I want to shout out friend of the show, Michael Kitsis, on his site, our friends Derek Tharp and Justin Fitzpatrick. Earlier this year, they wrote a whole post about this, so I would send any listeners there. But basically, Ben, that's my understanding too, is that your distributions will increase, right, a percentage pro rata when things are good on an uptrend, and they'll decrease when you're in a market drawdown. But back to my earlier comment, my opinion, Ben, there's no way to destroy risk. It just gets transformed, right? And so if you're taking higher distributions during good times, that will impact the probability of financial planning success during downtimes. And not just, Ben, you said 25%. If you take a look at the stagflation era, 62 to 74, distributions would have been around 57%, right? So if your retirement plan, using a GK distribution strategy, right? So if your retirement plan can sustain a 57%, distribution, variance, to your point about volatility, I would take a look at it, because ultimately with $6 million, like you're probably not going to outspend your money, right? So therefore I would probably go for it. I would just have a backup plan. The nice thing about a 4% rule is it's simple. Historically it's worked well, but then really it varies based on your portfolio size, right? I mean, that's the whole theory behind it. But back to Jerry's point from the onset, for folks at this amount of money, yes, I think your goal should be to spend it while you're living. Unfortunately, on a long enough timeline, we all run out.
It is nice to see, though, people trying to figure out how to spend more
dig it.
thoughtfully, because that's something I've been talking about a lot.
Yeah, and process beats outcome. So like having any strategy, any formula, I think will always trump, winging it. So in that sense, I'm pro.
What do we think Ken teaches? What would you guess based on this question?
Boy, yeah, that's a lot.
Engineering.
Yeah, I was going to guess mechanical
Something
engineering.
numbers based.
MLPs, I would agree. Yeah, maybe he's in mathematics, maybe physics.
He's very spreadsheet oriented. All right.
Yeah.
We got one more question.
Okay, last but not least, Callum writes, I'm a high-income taxpayer currently looking into moving excess cash into a tax-efficient municipal bond fund, but I'm trying to understand the diversification risk that comes with investing a large amount into one individual municipal bond fund. The fund is made up of 180 plus bonds, so in itself is pretty diversified, but is putting, say, 20% of your portfolio into one fund a silly move? I'm relatively risk averse, but have no other bond exposure right now, probably mixed between stocks, a rental property, and cash.
I mean, you could, maybe he meant concentration risk here. That's probably the bigger worry. You could be fine with a single bond fund. I think some people like the simplicity of that. I don't mind some more diversification in fixed income. So cash or T-bills are actually a good hedge against inflation, which a lot of people think would be silly, but those short-term rates adjust the quickest. And so they do best when rates are rising. Plus you have more liquidity and just a lack of volatility in those. Tips are for unexpected inflation. Treasuries can help if there's disinflation or deflation. So do you have to diversify within fixed income? Not necessarily, but I think it can help. Sure. And what do you think about the whole idea of munis as just a way for a tax strategy, Bill? Like, do you think overweighting munis helps with that side of things?
Yeah, no, 100%. For non-qualified, meaning taxable income, we've looked at this before in the show. I believe that's the Compound 162. You can go back and take a look. But yeah, you get a pretty big advantage for high-income taxpayers, specifically folks in high-income tax states. New York, California, tax rates are as high as 13%. So when you combine that with the top federal rate, your tax rate is 50% in some instances. And so using a muni strategy to generate tax-free income, you're basically getting a 50% boost over a taxable bond. And the whole point, in my view, Ben, correct me if you feel differently, of a fund is to diversify, right? So like diversifying amongst funds, in my view, as long as the duration, as long as you're looking at a reputable company, like the whole point is one-stop shopping, in that you can buy a fund and diversify there. Pay attention to fees, pay attention to everything else. But in 20% for a long-term dated investor, 100%, I think this is the right strategy, especially if your income tax is high.
Yeah, you're right. Yeah, as long as you understand what the fund is like. So John, throw the chart up. Munis can fall. So during the COVID crash, and a lot of fixed income fell, but it fell almost 20%. I mean, this is just a Vanguard tax-exempt bond fund. So these things can fall if things get a little hairy. So I don't mind spreading your bets a little bit in fixed income, but you'll probably be fine if you do, like you said, in a fund.
Yeah, municipal bond default rates are extremely low. And again, as long as your fund manager is doing the homework, look for high quality paper and keep the duration under 20 years. I don't see a lot of flaws in it. If you go back, Ben, to 2007, 2008, I think that was a bit worse. It was really the combination of COVID, but then all the infrastructure money came in, right, in 2020, 2021. But really, it was a change in interest rates that in my view, caused that big swing.
People got pretty scared.
With all of the data that we have now about the history of the market, is it really still considered risk averse to be heavily in bonds long term? Because couldn't you make the argument that you are definitely, missing out on big time returns by doing that? So is that really being risk averse? Aren't you missing out?
Well, yeah, we have to balance your the spreadsheet answer with your emotional answer. I think some people need bonds just to keep them invested in stocks. I think that's the trade-off.
Right. And
you
the
need
bond
that it's an emotional hedge for some people, not just a portfolio allocation kind of thing.
Yeah, and bond market's about 3 times the size of the stock market, right, in terms of AUM. And there's a reason for that. It's not just pension funds that are looking for this, but retirees looking for a diversified income stream. But yeah, strategically, full speed ahead, Colin. I think you're on the right path.
Dave in the chat said he can't believe it. We did a whole show with Bill Sweet, and there was not one Roth question.
We talked about Roth and recharacterization. That was pretty fun. Come on,
that was a
Dave.
little
Give
bit
me
of
some
Roth.
credits.
We mentioned it. We mentioned it.
Okay, before the show started, I asked you, Bill, as my tax man, I said, I need
Yep.
my 2022 tax return.
Yep.
Here's the reason why. I'm preparing for lower rates from the Fed. I have equity in my house. We don't have two households. I actually asked, since I have a vacation home, I said, can I take out equity on this house too? Can I take 2 home equity lines of credit? And they said, you sure can. And so I'm taking out a home equity line of credit on the vacation house just in case we want to do some renovations, right? We want to take that railing and turn it from a white vinyl railing into a glass railing so you can see the wake better, you know? And so I want to take out a home equity line of credit, take advantage. And they said we need 2 tax returns and we need your property taxes and all this stuff. And they said it could take up to 8 weeks. So I'm preparing. I'm not there yet. Rates are still pretty high, but I'm preparing to get more dry powder ready for when rates fall.
And my suggestion, Ben, is we do it live on the show. Next time on Ask the Compound,
do it.
we're going to
Can
look
you get a
through Ben
boat
Carlson's
equity?
tax return.
Can you get a boat equity line of credit with your Tritoon?
I think I'm down on that one probably, but
Yeah, anytime your house can float away, that's not a great investment.
this is true. Remember, if you have a question for us, email here, askthecompoundshow@gmail.com. Check in tomorrow with the Compound and Friends, all new. Check out the Compound Insider newsletter. Thanks to everyone in the live chat. We appreciate it. Even the people watching on Twitter, which is nice. Something new we're trying. Send us an email, leave us a comment, a review, all that good stuff. Hit the like, subscribe. See you next time.
Yep.
See you, everyone.